Welcome to Dan Capital, where we build rational wealth. I am Dan, and today we are talking about something that every American needs to hear before they sit down to file their taxes in 2026. You work hard for your money. You grind every single day, and the last thing you want is to hand over more of it to the IRS than you legally have to. So today, I am going to walk you through 7 completely legal ways to reduce your tax bill before you file. These are not loopholes for billionaires. These are strategies that everyday Americans can use right now, and most people are simply leaving this money on the table because nobody ever told them about it. So let us get into it. The first strategy is to maximize your contributions to a traditional IRA or a 401k. Now listen carefully, because this one alone can save you hundreds or even thousands of dollars. When you contribute money to a traditional IRA or a traditional 401k, that money comes out of your taxable income. So if you earn $60,000 a year and you put $6,000 into a traditional IRA, the IRS only taxes you on $54,000. You literally just made $6,000 invisible to the tax system, and it is completely legal. For 2026, the contribution limit for an IRA is $7,000. And if you are 50 years old or above, you can add an extra $1,000 as a catch-up contribution, making it $8,000 total. For a 401k, the limit goes all the way up to $23,500 with an additional $7,500 allowed for those who are 50 or older. If you have not been doing this, you need to start today. The earlier you fund these accounts before the tax deadline, the better off you are going to be. The second strategy is to use a health savings account, which most people call an HSA. This is one of the most powerful and underused tax tools available to Americans today. Here is what makes it so special. An HSA gives you a triple tax advantage. Your contributions go in tax-free. The money grows inside the account tax-free. And when you use it for qualified medical expenses, you take it out tax-free. That is a win in 3 different directions. To qualify for an HSA, you need to be enrolled in a high-deductible health plan. If you are, you can contribute up to $4,300 as an individual or up to $8,550 for a family in 2026. Every dollar you put into that HSA reduces your taxable income dollar for dollar. And here is the part most people do not know. You do not have to spend it right away. You can let it sit and grow as an investment, almost like a stealth retirement account that is also a medical fund. Dan Capital always says, do not sleep on the HSA. The third strategy is to harvest your tax losses. Now this one is specifically for people who have investments in a brokerage account, meaning a regular taxable account, not a retirement account. Here is how it works. If you have investments that have gone down in value, you can sell them to realize that loss, and then use that loss to offset gains you have made elsewhere in your portfolio. So if you made $10,000 in gains on one stock, but lost $4,000 on another, you can subtract the loss from the gain, and only pay taxes on $6,000 instead of $10,000. And if your losses are bigger than your gains, you can use up to $3,000 of those extra losses to offset your regular income as well. Any remaining losses can be carried forward into future tax years. This strategy is called tax loss harvesting, and it is perfectly legal. The one thing to watch out for is the wash sale rule. If you sell a stock for a loss and then buy the same or a substantially identical stock within 30 days before or after the sale, the IRS will disallow that loss. So be smart about the timing. The fourth strategy is to claim every deduction you are entitled to. Sounds obvious, right? But you would be shocked at how many Americans either take the standard deduction without checking whether itemizing would save them more money, or they itemize but miss deductions they are legally allowed to claim. The standard deduction in 2026 is roughly $15,000 for a single filer and $30,000 for a married couple filing jointly. But if your deductible expenses add up to more than that, you should be itemizing. What kinds of expenses qualify? Mortgage interest is a big one. State and local taxes up to a cap of $10,000. Charitable donations to qualified organizations. Medical expenses that exceed a certain percentage of your adjusted gross income. educator expenses if you are a teacher, student loan interest. The list goes on. And if you are self-employed, the list gets even longer because you can deduct things like your home office, your business mileage, your health insurance premiums, your professional subscriptions, and much more. Go through your finances carefully before filing. Every missed deduction is money you are giving away for free. The fifth strategy is to contribute to a 529 education savings plan. If you have children, or you are planning to support someone's education expenses, this is a tool you absolutely need to know about. Contributions to a 529 plan are not deductible on your federal taxes, but here is the catch. More than 30 states offer a state income tax deduction or credit for contributions to a 529 plan. So depending on where you live, you could be getting a significant tax break at the state level. And inside the account, the money grows completely tax-free as long as it is used for qualified education expenses, which now includes not just college, but also private school tuition from kindergarten through 12th grade, as well as certain apprenticeship programs. In recent years, the rules have expanded to also allow unused 529 funds to be rolled over into a Roth IRA for the beneficiary, subject to certain conditions. This makes the 529 even more attractive as a long-term wealth-building tool. The sixth strategy is to time your income and deductions strategically. This one requires a little bit of planning, but the payoff can be meaningful. The basic idea is that you want to accelerate deductions into the current tax year and defer income into the next tax year, if possible. For example, if you know you are going to make a large charitable donation, consider making it before December 31st so you can deduct it this year. If you are self-employed and expecting a big payment from a client, see if you can delay receiving that payment until January so it counts as next year's income. If you have significant medical expenses coming up, try to bunch as many of them as possible into the same calendar year so they are more likely to exceed the threshold needed to be deductible. This kind of income and deduction timing strategy is especially useful if your income fluctuates from year to year because you want to be in the lower tax bracket as much as possible when income is recognized, and you want your deductions to hit in the years when your income is higher and your tax rate is higher. It takes a bit of discipline and foresight, but it is one of the most effective tools a tax-savvy American can use. The seventh and final strategy is to take advantage of tax credits, not just deductions. Here is a distinction that a lot of people miss. A deduction reduces your taxable income, which means it saves you money at your marginal tax rate. But a tax credit reduces your actual tax bill dollar for dollar. So a $1,000 tax credit is worth exactly $1,000 off your taxes, regardless of what tax bracket you are in. That makes credits incredibly powerful. Some of the most valuable credits available to Americans include the Earned Income Tax Credit for low to moderate income workers, the Child Tax Credit, which can be worth up to $2,000 per qualifying child, the Child and Dependent Care Credit for expenses related to child care or caring for a dependent, the American Opportunity Tax Credit, and the Lifetime Learning Credit for education expenses, the Retirement Savings Contributions Credit, also known as the Savers Credit for lower income individuals who contribute to a retirement account, and the Energy Efficient Home Improvement Credit if you made qualifying upgrades to your home. Before you file, make sure you or your tax professional has gone through every credit you might qualify for. This is not optional. This is money sitting on the table with your name on it. So there you have it. 7 completely legal ways to pay less in taxes before you file with the IRS in 2026. Maximize your retirement contributions. Use your HSA to its full potential. Harvest your investment losses. Claim every deduction you deserve. Invest in a 529 if education is in your future. Time your income and deductions wisely. And never forget to check for every tax credit you qualify for. Here at Dan Capital, we believe that building rational wealth is not just about making more money. It is also about keeping more of the money you already make. The tax code is not your enemy if you understand it. It is actually full of tools designed to reward people who plan ahead. And that is exactly what we are here to help you do. If this video helped you, please like it, share it with someone who needs to hear it, and subscribe to Dan Capital so you never miss a strategy that could change your financial future. I am Dan. Stay rational, stay wealthy, and I will see you in the next one.